This is part 2 of chapter 2 video, and what I'm going to do in this video, I'm going to actually show you the mechanics of journalizing and posting business transactions. We're going to go through T accounts, journal, and ledger, and then I will briefly show you how to compose the trial balance. And then guys, the financial statements, again, you know them from chapter 1. There's nothing different about them. So I'll just briefly go over the slides, and then I will cover one ratio at the end of this chapter, which is the debt ratio. So we started chapter 2 with a picture on page 123, which is actually in chapter 3 of the accounting cycle. So what we're going to do right now, we're going to go through steps 1, 2, and 3 repeatedly using a problem. So I want us to, so instead of me lecturing here, I think it's just nice to go through a few examples. So we're going to analyze business transactions. So again, guys, we're going to follow these simple steps. We're going to read the transaction. We're going to set it up as T accounts. Now, this is not a part of many problems. Where do you do the T accounts? Please do them on a piece of paper. I'm just going to do them on a blank slide. Unless you took like a Business 7 course where you already studied T accounts, if you finished Business 7, you can directly jump to step 3 and journalize. If this is a new information for you, practice, practice, practice until you get it. Put the T accounts first. And then from the T accounts, we're going to journalize the transaction, and then from the journal, we're going to post it to the ledger. So those are 4 simple steps. There is a serial problem on pages 92, 93, 92, 93. If you're taking my online course, you will be completing this serial problem during the 4th week. After we cover chapters 1 to 3, you're going to do, I call it the accounting cycle problem. If you're taking my traditional or hybrid course, we usually do a project, paper-based project with different transactions, but the same idea, and we do it by hand. So pages 92, 93, here I have this serial problem. So this is a business, brand new business, small corporation, a service corporation. This is the chart of accounts. You have account names, so you cannot make up your own accounts. These are the only accounts you and I can use, and you see account numbers, and they follow the rules described in part 1 of chapter 2 video. And then guys, we have transactions. So we read the transaction, and then we're gonna put it in T accounts, and we're gonna journalize it, and then we're gonna post it to the ledger. I'm just going to go through a few of these, right? I'm not going to go through all of them, but that's what the accounting cycle is all about. The first 3 chapters are all about analyzing these transactions and then preparing financial statements. So October 1st, S-Ray invested $45,000 cash, $20,000 computer system, and $8,000 of office equipment in the company in exchange for common stock. So this is so-called a compound transaction. Usually transactions will have just 2 accounts, 1 debit, 1 credit. But in here we're going to have 1, 2, 3, 4 accounts. Cash, computer, instead of computer system, we're going to say computer equipment, office equipment, and common stock. So let me go right here and let me set up those T accounts. So October 10th. So October, you don't have to write a date. So this is just on a piece of paper. We're going to have October 1st. 4 accounts. We're going to have cash. I'm just abbreviating. We're going to have computer equipment. We're going to have office equipment. So these are 3 types of assets the owner is investing in a business. It's not just cash that the owners invest. They could invest other assets. And in exchange, they receive common stock, right? So these are my 4 accounts. The first 3 are assets, so plus, minus, set it up, take your time, plus, minus, and common stock is an equity account, so it's minus, plus. So my debits must be equal to credits. That's the whole idea of the double entry accounting system. So I'm going to debit all of the first 3 accounts, Cash goes up 45,000, right? Because the business is receiving cash. And computer equipment is going up 20,000. So instead of saying going up, I should say debit cash. Left means debit. Debit cash means it goes up. Debit computer equipment goes up. Debit office equipment 8,000. And the transaction does not tell me how much common stock, but we just gonna add them up. So 45 plus 20, 65 plus 8, and that's 73. You see, it's also going up, but it's now a credit. So I have 3 debits, right? And I have 1 credit, and they're equal. This is equal to this 1 credit. So within every transaction, the debit and credit, or debits and credits are equal. It could be all pluses, could be plus minus, could be all minuses, but it's a double entry accounting system. It's pretty much we're entering the same transaction in 2 different places. So then at the end, we can double check ourselves and make sure we did not make any mistakes. That's a cool system, very cool system, invented in the 16th century by a Venetian monk, and we're still using it. That's it. So now I can go to the journal. I'm going to list accounts debited first, and then I'm going to list account credited last. So this will disappear. Let me go now to the journal. So this is my journal. Again, you just take it from T accounts. Cash debit $45,000. By the way, here you see they give you the date. If you do it in a piece of paper, you put the date first. Then you put all your debited accounts. Computer equipment, not computer supplies, that would be a mistake. Office equipment. So computer equipment is 20,000. Office equipment is 8,000. Look at these entries. They're debits. It doesn't matter really in which sequence I list them. They are all at the margin. I don't write them in the middle of the column. I just put them at the margin. But the credited account is common stock. I can just start typing. And guys, when it's a credit and we said it is $73,000, look what happens with the name. It's indented. So if you do it on a piece of paper, I know it's a credit if it's indented. And then guys, we actually have to write some description right here. So we would mention any kind of source documents if they're given to us, so the auditor knows where it comes from. But in this class in Business 1A, you can omit, you can skip the description. That's it. That's a journal entry. I record the entry. That's my journal entry. I recorded it. Now, simultaneously, right away, I should go into the ledger, which is requirement 2, and I'm going to copy, post these accounts. So I'm going to go take cash, debit 45,000. So this is October 1st, and it's for cash, right? So right here it's just cash. It's $45,000, and so the balance is $45,000. Notice the balance column is just 1 column. It's always going to be debit, right? So this is your T account pretty much. For cash, if you have a debit entry, the balance goes up. If you have a credit entry, the balance will go down, but the balance should never be negative. The second one was computer equipment. There it is. And again, I choose the date and I say 20,000 debit, and it's an asset that becomes the balance. And then office equipment is October 1st, $8,000. You can, oops, sorry, this is the date. You can see that the ledger is very tedious. There is no thinking. If you've done the journal correctly, the ledger is usually done automatically, right? You will have to complete the ledger just in this chapter, chapter 2. They always come together, journal ledger. But for the rest of the course, we will assume the ledger is done, but you will not have to actually do the posting. And then guys, common stock, this is again October 1st, and it's a credit entry. Again, I forget, it's 65 plus 8, $73,000, right? So for common stock, the balance is credit because it's minus plus. So the credit entry increases the balance. If I had a debit entry, the balance will go down. That's it. I'm done. I'm ready for the next transaction. The company or we paid 3,000 cash for 4 months rent. Not 3,000, 3,300. So again, if I go right here, and this is October 2nd, this is a transaction which just impacts two accounts. It doesn't matter, by the way, which account you list first when you do T accounts. So I will list cash first, and then prepaid rent second. Prepaid rent. And guys, both are assets, so it's plus minus, plus minus. But we pay cash. Whenever you pay cash, cash is credited, right? So it's $3,300 credit. This is credit. I don't have to write credit, but the right side means credit. And prepaid rent now goes up. Remember, it's not an expense until I actually use it up, right? I prepay for 4 months, and so now I have this asset prepaid. That's a debit. I have a debit and a credit. Again, it doesn't matter here which account you list first. You cannot have a transaction where you would have two debits, you would have two accounts and two entries on the left. That's wrong. You cannot have two accounts and there are two entries to the right. That's wrong. You have to have left and right or right and left. So this is wrong. Now, when I go to the journal, I cannot list cash first. I must list account that is debited first. Always, 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 always. It doesn't matter if it's increased, decreased. So when we go to the journal, right here, we're recording the second transaction. Oops. Next transaction. How do I do next transaction? Okay, next transaction. So I'm going to do prepaid rent first, 3,300, and I'm going to do cash second, 3,300. Again, look, whenever I enter cash, look, it's indented. You see how it's indented? Okay, let's record the entry, and let's go to the ledger. So cash, this is October 2nd, cash went down $3,300. So look what happens with the balance. You see the balance went down? So that's your checking account, right? The owner gave you 45K and then the owner took out, and then, I'm sorry, you paid for 4 months for rent, so the balance went down. And then prepaid rent, here we go, October 2nd, it's an asset, so it has a normal debit balance. There is the balance. And so guys, we keep going through these transactions. Then we're gonna record the transaction number 3, transaction number 4, transaction. Let me do just a couple more. So transaction number 3, the company purchased computer supplies on credit. Again, I'm not going to go through T accounts, but you should. So I debit here supplies, computer supplies actually, right? Computer supplies goes up, debit, and on credit means accounts payable. So accounts payable also goes up because it's a liability, minus plus. So this is my transaction, this is my transaction. And then I post it to the ledger. And then couple more, I paid 1 year premium on property and liability insurance. So we are prepaying for prepaid insurance, and we're paying with cash. And so debit is 2220 and cash is 2220. So I will stop here, guys, but this is what you have to do, right? You have, oops, that did not register. If you get the T accounts, then it's just a copy of the T accounts that goes to the journal, and then you just copy to the ledger. So that's the most important kind of mechanical part. At the end of this problem, I will have the ledger completed, and I will have balances for all accounts in the ledger. So before preparing financial statements, what we will need to do, we will need to make sure that we did not make any mistakes. So step 4 of the accounting cycle is to prepare so-called unadjusted, before adjustments, unadjusted trial balance. I do want to mention that trial balance is not a financial statement. It's an internal report. It's prepared for one date. It does have three columns: account column, debit column, credit column. And so if you're actually using any software, you click and the trial balance is generated. There is no thinking. You just list all accounts from the ledger in the same sequence. Usually if the account has a zero balance, you still list the account, put a zero, or you can skip it, it's up to you. And then you put all the balances in the appropriate columns. So your assets, expenses, and dividends must have the debit balances in the ledger, and then they go in the debit column. And then your liabilities and your revenue and your your equity accounts have a credit balance. So look right here, we still have a title like financial statements, but it's not a financial statement. Who, what, when. It's a date, not a period of time. You list accounts in the same sequence. You don't say assets, but you can see assets are listed first. You have two liabilities. We don't have retained earnings because it's a brand new business. You have two equity accounts, two revenue accounts, and three expense accounts. Again, you just copy balances from the ledger. What you want to see is that assets, expenses, and dividends are on the left. They have debit balances. AED, after eating dinner. And then your liabilities, your revenues, and your common stock, right? LRC, Let's Read Comics, have credit balances. You have to be equal. If you're not, you cannot proceed, and there are different ways of identifying types of errors. But I have to make sure that my debits are equal to my credits, hence the name, the trial balance. After this is prepared, we actually have to then make adjustments and prepare the adjusted trial balance in reality. But your textbook just skips a couple of steps and says prepare financial statements. And guys, these are 4 financial statements I covered in detail in chapter 1. What I do want to mention now that really for the rest of the class, you just have to worry about the income statement and you have to worry about the balance sheet. You don't have to worry about the statement of retained earnings. You will not really see it ever for the rest of the course. And you will not see the statement of cash flows because at Ch2, we're covering the statement of cash flows, which is chapter 12. We actually cover it in Business 1B. So you will have a whole separate chapter on that statement at the end of your managerial accounting course. So the income statement that shows the company's operations, do we have an income or do we have a loss? And the balance sheet, which describes the company's financial position, is just a reflection of the accounting equation. Assets are equal to liabilities plus equity at a point in time. And so guys, this is an example of the income statement. Nothing to it but revenues minus expenses. 2 revenues, total revenues, 3 expenses. Notice, financial statements don't say debit credit. If I go back to the trial balance, it does say debit credit because it's an internal report. It's for us, for accountants. My stockholders, the IRS, lenders, they do not know debit from credit and they don't care. There are 2 money columns which simply represent, it's just easier to read. The single standing amounts and the amounts that will be directly added, they go to the left, and the subtotals and grand total go to the right. Revenues minus expenses gives me net income. Has nothing to do with debit and credit. And then guys, we use net income right here to prepare the statement of retained earnings. Beginning balance plus net income minus cash dividends equals to ending retained earnings. And we will use this ending retained earnings to prepare the balance sheet. And the balance sheet, I add up all my assets, and you can see total assets right here. And then I add up liabilities and equity. I use I use the ending retained earnings, right? Instead of a 0, I use this 3195. So your total liabilities plus total equity together give you the same number as total assets, and it proves that we are in balance. hence the name, the balance sheet. Okay, the last part of this chapter just talks about one ratio. And this is a ratio that looks at leverage. It looks at the company's solvency, like how much does the company rely on debt, on liabilities. And for this ratio, we take total liabilities divided into total assets. We are looking at how much of of a dollar of an asset is invested with borrowing, right? And so this debt ratio is actually, I want it to be lower, right? If this ratio is less than 1, less than 100%, it means that I have, I have less liabilities than assets. Actually, it should be less than 50%. Then if it's less than 50%, less than 0.5, I should say, that means I would have more equity than liabilities. So if, for example, this ratio is 30% or 0.3, it means that for every dollar of assets, 30 cents are paid financed with liabilities, and 70 cents are financed with equity, which is good. If my debt ratio, however, is 80%, that's not good. That means that for every dollar of assets, 80 cents is financed with debt, and only 20 cents is financed with equity, right? So I want this ratio to be lower. A higher ratio indicates that there is a greater probability that the company will not be able to pay its debt in the future. So it shows the amount of risk for investors, but also for lenders. So this concludes part 2 of chapter 2, which concludes chapter 2. Thank you for your attention.